Over the past 5 years, Coca-Cola is up by only 15%, and over the past 6 months they are down by about 1.5%. Now in today's video, I want to take a deep dive into Coca-Cola's financials and figure out its intrinsic value. I will also explain why I sold out of my Coca-Cola positions when it was trading at about $70 a share. Now right away we can see that Coca-Cola has a dividend yield of 3.10% with a high trailing free cash flow payout ratio of 90%, which means that 90% of the free cash flow they generate goes into paying out dividend. Now normally to me this would be an extremely high value, but with Coca-Cola I don't really mind, as they don't need to push a lot of their free cash flow into innovation. Now jumping straight to the 9 pillars, we can see that the company gets a rating of 7 out of 9. Now the first thing I don't like about Coca-Cola is that they have increasing shares outstanding. As they are a well-established company, I would really expect them to be buying back shares, as they don't need the extra free cash flow. Also by buying back shares, they would increase the value of the shares outstanding. On the other hand, we can see that Coca-Cola has very steady revenue, free cash flow and net income growth, all sitting at about 5% yearly over the past 5 years. Now, even though the growth is very steady, as we can see on the graphs right here, this is one of the reasons why I sold out of my Coca-Cola position. Because a company's share price growth is a reflection of their profits growth, and so I expect Coca-Cola to grow at a rate of about 5 to 7% yearly, which doesn't fit into my personal portfolio. Now this could be compensated for with high dividend and high consecutive dividend growth, and as we can see, Coca-Cola's dividend growth is sitting at 3.66%. Now if we have a closer look, we can see that 3.66% is actually below the average of 4.13%. They do have a higher dividend yield of 3.10%, but the main thing I look for in my dividend companies is the high consecutive dividend growth, so it can kick in the dividend snowball effect. Now we can also have a look at their 5-year PE ratio and their 5-year price to free cash flow. If we have a closer look at the PE ratio, we can see that currently that is sitting at 25.98, which is lower than the 5-year average. Now this is above the range we like to see, but as Coca-Cola is a well-established company, I am willing to pay a premium for it. Now that is a different story with the price to free cash flow that is currently sitting at 27.82 and has been increasing at a rate of 6.38%, and is quite a bit above the range we'd like to see, and so Coca-Cola would be considered overpriced compared to their free cash flow. But now let's calculate the company's intrinsic value, first using the Graham's formula revised. And here we plug in the 5-year earnings growth estimate of 7.59% yearly and calculate an intrinsic value of $40.93, which is 53% lower than the current trading price. Now for the second valuation model, we look at the free cash flow of the company and calculate the future growth rate of 3.7%. Now plugging in a discount rate at 5.9%, we get an intrinsic value of $67.96, which is slightly higher than the current trading price. Now for the multiples valuation, we want to compare Coca-Cola to PepsiCo, and comparing their PE ratios, we get an intrinsic value of $56.60. Now for the final valuation model, the dividend discount model, we project a future growth rate of 3% and get an intrinsic value of $64.76. And finally, we will average out these 4 valuations and get an ultimate intrinsic value of $57.56, which is 8% lower than the current trading price. But I'm not saying that it's not a good investment. Coca-Cola is a well-established company and it will grow into the future. It just won't grow at the rate that I want it to. It's a low-risk investment that will bring lower return. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.